Hey everyone, welcome back to the channel. Today, we redive in deep into a topic that separates the pros from the amateurs in the investing world. Financial statements. You might hear terms like balance sheets, income statements, and cash flow statements and think, "Oog, that sounds like homework." But I promise you, by the end of this video, you'll understand why smart investors are absolutely obsessed with these documents. They are the secret maps to finding buried treasure in the stock market. So, what exactly are financial statements? Think of them as a company's report card. They tell you the real story, not just the hype you hear in the news or on social media. There are three main reports we need to know: the income statement, the balance sheet, and the statement of cash flows. Together, they paint a complete picture of a company's financial health. Let's start with the income statement. This is probably the one you're most familiar with. It's also called the profit and loss, or P&L, statement. It shows you how much money a company made its revenue and how much it spent its expenses over a specific period, like a quarter or a year. The bottom line of this statement is the famous net income or profit. Is the company actually making money? Is its revenue growing year after year? Are its costs under control? The income statement answers all these crucial questions. A smart investor looks for consistent revenue growth and healthy profit margins. If a company is selling more but its profits are shrinking, that's a red flag that its expenses might be out of control. Next up, we have the balance sheet. If the income statement is a video of the company's performance over time, the balance sheet is a snapshot at a single point in time. It shows you what a company owns, its assets, and what it owes, its liabilities. The difference between these two is the shareholder's equity. A simple way to think about it is assets equals liabilities plus equity. What do smart investors look for here? A healthy balance sheet shows that the company's assets are greater than its liabilities. You want to see if the company is drowning in debt? Too much debt can be risky, especially if interest rates rise or the economy slows down. We also look at the quality of the assets. Does the company have a lot of cash? Or are its assets tied up in things that are hard to sell? A strong balance sheet provides a safety net for the company. Now, for my personal favorite, the statement of cash flows. This one is the ultimate truth. A company can play around with accounting rules to make its profits on the income statement look good, but it's much harder to fake cash. Cash is king, right? The cash flow statement tracks all the real cash moving in and out of the company. It's broken down into three parts: cash from operations, cash from investing, and cash from financing. Cash from operations tells you if the core business is generating cash. This is super important. A company should be able to make money just by doing what it's supposed to do. If a company reports a big profit but has negative cash flow from operations, you need to investigate why. It could be a sign of trouble. Cash from investing shows how the company is spending its money on long-term growth, like buying new equipment or other companies. Cash from financing shows how the company is raising money, whether by issuing stock or taking on debt, and how it's returning money to shareholders, like through dividends or stock buybacks. A healthy, growing company will typically show positive cash flow from operations, negative cash flow from investing because it's reinvesting for the future, and a mix of financing activities. So, why go through all this trouble? Why not just follow stock tips from your favorite influencers? Because financial statements allow you to do your own homework. They help you understand the business behind the stock ticker. You're not just buying a random set of letters. You're buying a piece of a real business. Reading these statements helps you answer the most important questions. Is this business profitable? Can it pay its bills? Is it growing in a sustainable way? Is management making smart decisions with the company's money? Let's take a real-world example. Imagine two companies in the same industry. Company A has soaring revenues, but its debt is piling up, and it's not actually generating any cash from its main business. Company B's revenue growth is a bit slower, but it has almost no debt, a huge pile of cash, and strong, consistent cash flow from its operations. On the surface, the headlines might be all about Company A's exciting growth, but a smart investor who reads the financial statements will see that Company B is the much safer and likely more profitable long-term investment. Company A is a house of cards, while Company B is a fortress. This is what legendary investors like Warren Buffett do. He spends hours a day reading financial reports. He says it's like reading a story about a business, and he's looking for a good story with a happy ending. By learning to read these statements, you can move from being a speculator, who is essentially gambling, to being an investor, who is making informed decisions based on facts. You start to see the market not as a casino, but as a place where you can partner with great businesses. Getting started might feel intimidating. The first time you open a company's annual report, it can look like a foreign language, but don't be discouraged. Start with companies you already know and use, like Apple, or Nike, or Starbucks. Look at their revenue. Is it going up? Look at their net income. Are they profitable? Check their balance sheet for debt. It's a skill that builds over time. The more you do it, the easier and faster it becomes. There are also tons of great resources online that can help you understand specific terms and ratios. Understanding financial statements gives you a massive advantage. While others are chasing hype and getting burned, you'll be able to spot high-quality, durable businesses trading at fair prices. You'll be able to avoid companies with hidden problems and identify opportunities that the market has overlooked. It empowers you to think for yourself and build real, long-term wealth with confidence. You stop relying on luck and start relying on knowledge. So, the next time you're thinking about investing in a company, don't just look at the stock price chart. Take the time to pull up its latest financial statements. Look at the income statement, the balance sheet, and the statement of cash flows. See what story they tell you. It's the most reliable way to understand the health and potential of a business. And it's the #1 habit of truly smart investors. Thanks for watching today. I hope this gave you a new perspective on how to approach investing. If you found this helpful, please hit that like button and subscribe for more content to help you on your financial journey. Let me know in the comments if you have any questions or if there is a specific company has financial statements you'd like me to analyze in a future video. See you next time.